Imagine a company that just reported earnings beating expectations by over 700%. Sounds incredible, right? But the stock crashed 27% the very next day. Welcome to the strange case of Duolingo's Q3 2025 earnings. Today, we're diving deep into what actually happened behind those headline numbers and whether this crash makes sense. I'm breaking down the forensic financial analysis of Duolingo, the company teaching the world languages through an addictive green owl. Let's get into it. Let's start with what everyone saw. Duolingo reported Q3 revenue of $271.7 million, up 41% year over year. That's massive growth. But here's where it gets interesting. Earnings per share came in at $5.95 compared to analyst expectations of just 72 cents. That's an 826% beat. Wall Street should have celebrated, right? Wrong. The stock dropped from around $260 to $190 in a single day. Trading volume exploded to 670% of the average. So what's going on here? Here's the key detail most people missed. That 5.95 earnings per share included a one-time tax benefit of $222.7 million. That's $4.83 per share of non-cash accounting magic. Strip that out and the true normalized earnings were about $1.12 per share. Still a beat of the 72-cent estimate by 56%, but nowhere near that 700% headline. The market saw through the accounting treatment immediately. This tax benefit came from releasing a valuation allowance on deferred tax assets. It's legitimate accounting, signaling confidence in future profitability, but it's not recurring cash. Now let's talk about what's actually driving this business. The user metrics are exceptional. Daily active users hit 50.5 million, up 36% year over year. That's accelerating from 30% growth in Q2. Monthly active users reached 135.3 million, up 20%. But here's the critical metric. The ratio of daily to monthly users improved to 37.3%, up from 32.9% a year ago. This means users aren't just signing up, they're coming back every single day. In the app world, this kind of engagement is gold. For context, Instagram has a DAU to MAU ratio around 25%, Facebook around 65%. Duolingo at 37% is building serious habit formation. The engagement translates directly to revenue. Paid subscribers reached 11.5 million, up 34% year over year. Subscription revenue, which makes up 84% of total revenue, grew 46% to $229.5 million. That's growing faster than total revenue, which is exactly what you want to see. The paid penetration rate sits at 8.5%. Only 1 in 12 monthly users is paying. Compare that to Spotify at 50% paid penetration or Tinder at 10%. There's enormous runway for Duolingo to convert more free users to paying subscribers. Average revenue per user is around $80 annually, with room to grow as the premium max tier gains traction. Let's examine profitability. Gross margin came in at 72.5%, down slightly from 72.9% a year ago. The compression is due to AI costs associated with the Duolingo Max subscription tier, which uses GPT-4 for personalized tutoring. But here's the positive story. Operating margin expanded dramatically to 12.9% from 7% a year ago. That's 590 basis points of improvement. Revenue is growing 41%, while operating expenses are only growing 28%. This operating leverage is exactly what investors want to see at scale. Adjusted EBITDA margin hit 29.4%, up from 24.7%. The company is proving it can grow fast and expand margins simultaneously. Now let's talk cash. Operating cash flow in Q3 was $84.2 million. Free cash flow after minimal capital expenditures came in at $77.4 million, up 51% year over year. That's a free cash flow margin of 28.5%. Compare that to normalized net income of around $46 million, and you see cash generation exceeding accounting profits. That's high-quality earnings. For the 9 months, free cash flow totaled $267 million. The business model is capital light. Total capex is only 2.5% of revenue. Duolingo doesn't need to build factories or buy expensive equipment. It's a software platform that scales beautifully. The balance sheet is a fortress. Cash and investments total $1.2 billion. Total debt, $93 million, but that's just operating leases, not financial debt. This gives Duolingo a net cash position of $918 million. The current ratio is 2.82, meaning $2.80 in current assets for every dollar of current liabilities. There's zero liquidity risk here. This financial strength provides strategic optionality. The company could fund acquisitions, buy back stock at these depressed prices, or simply outspend competitors on marketing and product development. The balance sheet is a competitive weapon. Every investment has risks. Let's examine the red flags forensically. First, customer concentration. 68% of accounts receivable comes from Apple, 15% from Google, and 11% from Stripe. That's 94% concentration in three partners. This creates platform dependency risk. If Apple or Google change their App Store commission rates or policies, Duolingo's economics change overnight. The company is addressing this by growing direct billing through Stripe, which now represents over 10% of revenue. But the concentration remains a moderate concern. Second, stock-based compensation runs at 13.1% of revenue. That's material dilution, though it's improving from 15% a year ago. Third, insider selling has been elevated. The CTO, CEO, and Chief Engineering Officer all executed significant sales in October and November through pre-planned 10b5-1 programs. These were scheduled in advance and occurred when the stock was near all-time highs, around $545. It's rational profit-taking, not panic selling, but it's worth noting. Fourth, the gross margin compression of 40 basis points year over year is a yellow flag. AI costs for the max tier are rising. If GPT-4 pricing increases or usage grows faster than expected, margins could compress further. The company needs to demonstrate that the max tier premium pricing of $168 per year justifies these AI costs. The elephant in the room is generative AI. ChatGPT and Google Gemini now offer free language tutoring through voice conversations. Why pay $60 to $168 per year for Duolingo when you can practice Spanish with ChatGPT for free? This is a legitimate existential question. Duolingo's defense is its gamification moat. The streak mechanic, where users maintain daily learning streaks, creates powerful habit formation. The 37% daily active user ratio proves this stickiness. Social features like leaderboards and friend challenges add network effects that ChatGPT can't replicate. The company is also fighting AI with AI, integrating GPT-4 into the max tier. But make no mistake, this is a real competitive threat. If daily active user growth decelerates below 25% for 2 consecutive quarters, that's a signal the AI substitution is happening. Let's talk valuation. At $190.64, Duolingo trades at 9.2 times price to sales and 31 times forward price to earnings. That's a premium to education software peers, which trade around 6 times sales on average. But Duolingo is growing revenue 41% versus peer median growth of just 1.5%. That 39 percentage point growth advantage justifies a premium. Using a reverse DCF model, the current price implies revenue growing at 32% annually through 2030, with free cash flow margins compressing to 22%. Both assumptions seem conservative. The company is currently delivering 40% plus growth with 28% free cash flow margins and showing operating leverage. I've modeled 3 scenarios. In the bear case, revenue growth decelerates to 21% as AI competition intensifies and paid subscriber growth slows to 18%. EBITDA margins compress to 22%. The stock could fall to $130, down 32%. Probability 25%. The base case assumes revenue grows 38% in fiscal 2026 to $1.2 billion, with margins stable at 26%. That implies the stock is fairly valued at $190. Probability 50%. The bull case has revenue growth accelerating to 50% as the max tier succeeds and international markets explode. Margins expand to 30%. The stock could reach $280, up 47%. Probability 25%. Risk reward is asymmetric to the upside. The Duolingo Max tier is the critical catalyst to watch. Launched in early 2024 in select markets, Max costs $168 per year, 2.8 times the standard super tier at $60. It offers GPT-4 powered features like personalized explanations, AI role play conversations, and video call practice. The company hasn't disclosed Max subscriber numbers yet. If the Q4 earnings call in February reveals over 750,000 max subscribers with retention rates above 65%, that validates the premium pricing strategy. It would prove users see value in AI features worth paying for, not just using free ChatGPT. This would be a major de-risking event for the AI competition narrative. Conversely, if max adoption disappoints with under 300,000 subscribers, that's a red flag. Here are the key metrics to track quarterly. First, daily active user growth. Current rate is 36% year over year. Watch for deceleration below 25%. That would signal engagement is plateauing. Second, paid subscriber growth at 34%. If this drops below 25% for 2 quarters, the monetization engine is slowing. Third, gross margin, currently 72.5%. If this falls below 71% for 2 consecutive quarters, AI costs are becoming unsustainable. Fourth, paid penetration rate at 8.5%. Stagnation here for 3+ quarters means the conversion ceiling has been hit. Fifth, implied average revenue per user, currently around $80. This needs to grow to $85 or $90 by year end to show max tier mix shift. So why did the stock crash 27% despite strong fundamentals? I believe it's an overreaction driven by 3 factors. First, confusion about the $222 million tax benefit. Many investors saw the 5.95 earnings per share and assumed it was unsustainable without understanding the normalized $1.12 still beat estimates by 56%. Second, profit taking after a massive run. The stock had reached $545 earlier in the year. A correction from those levels was overdue. Third, lack of explicit guidance raise. Even though results were strong, management didn't provide aggressive fiscal 2026 guidance, disappointing bulls expecting more. The fundamentals, user growth, margin expansion, cash generation are exceptional. The 27% drop disconnects from operational reality. Let's summarize. Duolingo reported strong Q3 results with 41% revenue growth and accelerating user engagement. The headline earnings beat was inflated by a one-time tax benefit, but normalized profitability still exceeded expectations. The stock crashed due to confusion and profit-taking, not fundamental deterioration. Key strengths include 36% daily active user growth, 84% subscription revenue mix, expanding margins, and a fortress balance sheet with $918 million in net cash. The main risks are generative AI competition, platform dependency on Apple and Google, and potential monetization ceiling at 8 to 10% paid penetration. At $190, the stock appears fairly valued in the base case, with asymmetric upside if the max tier succeeds and international markets accelerate. The Q4 earnings call in early February 2026 will be critical. That's the deep dive on Duolingo's Q3 earnings and the market's overreaction. If you found this analysis valuable, subscribe to the channel for more forensic breakdowns of earnings reports and investment opportunities. Remember, we're examining the numbers and telling the story, not telling you what to do with your money. This material has a purely educational character and does not constitute an investment recommendation. Always do your own research and consult with a financial advisor before making investment decisions. Thanks for watching, and I'll see you in the next one.